Well, our next guest says there is a magic number to watch in tomorrow's jobs report. Let's bring in Mark Cabana, head of U.S. rate strategy at Bank of America. Mark, welcome back to the show. What is that number? And we should preface this with that tomorrow's jobs number is going to be a little tricky because of temporary census hiring. And so it won't be completely a clear number here.
That's right. So I think you want to look at the private payroll growth there, which we think will be relatively robust, around 125,000, pretty close to where consensus is right now. But I do think that right now the market's very fragile. It's very worried about a potential slowdown that is expanding beyond surveys and into the jobs market. You've not seen claims really back up yet, but I do worry what the bond market is telling you is that if you see a number, let's say below 100,000 or something like that, that will be a real sign of concern that this slowdown could be a bit more broad-based than we had perhaps initially expected. Now, similarly, if you see a number that's, let's call it 175,000 or higher, I think that would provide a lot of relief to the market. And I do think that what the market wants right now is good news about the economy, because it's had a pretty bad string of data. Consumer confidence last week, the services and non-manufacturing components this week have been a bit troubling. And right now, the bond market is sending pretty bad signs. It's expecting the Fed to move beyond this sort of insurance cut or mid-cycle adjustment that the Fed has been in and into something that's more like a recession firefight. So you're now expecting, with almost full pricings, a cut in October from the Fed and another cut in December from the Fed. It's about 20 basis points priced for each, about 80% of each one of those. And then another couple of cuts next year from the Fed. So the market's becoming a bit more pessimistic, and they're telling you, I think, that there's good reason to worry about how durable economic growth will be in the future.
Today's session was really interesting to watch in that equities markets bounced and the rates market still rolled over and went to new lows. And so I'm wondering how vulnerable you think rates are going into tomorrow's print, and what happens if we do get a negative number.
Yeah, so there's, I think, a lot of bad news that's already priced, and I think that that's probably how the market is currently leaning right now in terms of positioning.
In the bond market?
Yes, in the downward yield direction. So a lot of bad news that's already in there. Therefore, you might see a little bit of a bigger, bounce higher in yields if you do get a more positive number. But again, I think if you see a number that's roughly around 100,000, there's no magic number here. I do worry, though, that a number that's below 100,000 is clearly below the break-even rate at which the jobs market is expanding, and it'll tell you that there's real risks that the unemployment rate starts to rise for bad reasons. If you see that kind of print, I do worry that the market's going to be believing that there are much higher risks of a recession in the near term. Now, it's not our baseline, but if you see the jobs market go, and if you see the consumer go, we know that the consumer has been the only thing that's been keeping the economy really resilient right now. If those factors start to fade, then I think that you do need to worry about a more prominent slowdown in the U.S.
Let me ask you, GM, 48,000 workers who are currently still employed, right? Although I think they're getting $200 or $250 a week. When does that start to bleed through? How long does that last before maybe the suppliers or whoever feeds into GM starts to have an effect?
Yeah, so there could be some distortions due to the GM strike that's going on right now. How long does it take to necessarily bleed through? It's certainly not a positive for the economy right now. But what I would say is that it is encouraging that you've not yet seen initial jobless claims really begin to rise materially, right? We had those numbers this morning. They were still relatively resilient, slightly higher than the market was anticipating, but not really showing signs of material concerns about the labor market just yet. The strikes won't help provide a real clear picture on how the economy is evolving. But I do think that if you see a pretty significant downside risk, that's all you really need to, or miss, that's all you really need to know.
So, Mark, we've had people come through here and talk about the bond market and credit spread. So the difference between the yield on high yield and treasuries. We haven't seen a meaningful widening out, although the last 2 days there was a bit of a widening out. What are you seeing in that market? Are there cracks in high yields that we should be concerned about?
It's been remarkably resilient, and I think there's a few reasons for that. Number one, the equity market has held in quite well. Number two, you're seeing, I think, spillover from investors abroad into the U.S. market. There is a bit of a global chase for yield, and foreign investors can still get a nice return on investing in higher yielding U.S. corporate debt at the moment. And so those are very, very positive technicals. It also helps that there's the expectation that the Fed is going to begin to grow its balance sheet in the relatively near future to deal with some of these repo market disruptions that we have seen. Not quantitative easing, but due to more technical factors that have caused short-term interest rates to spike somewhat. That's another positive technical, I think, for the high yield market. So those are all quite favorable at the moment. Now, if the U.S. economy begins to show broader signs of a slowdown, if the consumer cracks, then I would think that you could see a bit more spread widening in those areas.
Will we see yields go lower? Will we see yields hit new lows? And do you think at the same time that the spread could actually widen?
So it's certainly possible. We think that rates will be going lower, just given economic fundamentals, the perception that consumer confidence is deteriorating, that percolating through the economy, and a Fed which will stop slow walking the eases, again, moving out of this insurance cut area to now being likely more responsive to broader signs of slowdown in the economy. We think that all of that will put downward pressure on base borrowing rates, and our forecast is for the 10-year by the end of the year to hit 125. So, new lows, at least, in the base borrowing rate. Not particularly optimistic. We don't believe that you've seen the lows thus far this year. We think that there's still a bit more downside to yields there. And it really depends on how responsive the Fed is, how they boost risk sentiment, and how the equity market holds up. And again, there's positive technicals in the credit markets right now, but if the economy begins to slow, I think that you'll see spreads widen just because the economy should trump some of those technical factors.
I mean, the interesting on the 10-year never made the low, right, whereas the 30-year did. So you're in the camp that obviously it does, and it does it substantially.
I mean, again, we think that there's downside risks. And when you've got a global backdrop where you've got negative rates around the world, where you've got monetary policy at the lows in many other developed markets, we think that that's another technical that's going to keep putting downward pressure on long end rates.
Mark, great to see you. Thank you.
Thanks
Mark
for having
Cabana,
me.
Bank of America Merrill Lynch. 125 on the 10-year.
I tell you what, for a lot of, by the way, great stuff by Mark. Spitting image of Dustin Pedroia, second baseman for the Red Sox.
Yes, sure. I was thinking that myself.
I bet he hears it all the time. He's not here anymore on the desk, but I bet he hears it.
There he is.
So 125 on rates. What does that mean ultimately for a lot of the trades that have been, call them defensive trades? It certainly does a lot for multiples. It does a lot for staples. I would also argue it's a deflation trade. So anything that we've seen in terms of asset prices and people that have been trying to push into either commodity-related plays or things that are all about asset, not good news. And in fact, those are trades that were part of that big, massive rotation, and it could be smacking a lot of people in the face because that's going straight down.
We see 125 on the 10-year. What do markets do?
I think the equity markets are lower if you see 125. I don't think the Fed cutting rates and low rates are going to change the economic outlook whatsoever. I think there's very good odds that that's going to happen. If you look at what's happening in Europe, those yields are zero at this point in time. Using Japan as your historical kind of benchmark, they don't come off of zero for a long period of time. So you're going to get this flow into U.S. fixed income, into rates, but that is not going to have an impact on the economy whatsoever.